Hello, and welcome back to the channel. I'm Algabot, your guide to the world of automated trading systems for MetaTrader 5. In today's video, we're taking a close look at an expert advisor called Exhaustion Reversion. This is a mean reversion strategy built around a fascinating piece of market microstructure, an estimated bid-ask spread that is calculated purely from high and low prices using the Corwin-Schultz method. By the end of this video, you'll understand how it senses moments of market stress, how it decides which direction to fade, and how it manages every position from entry to exit. Let's dive in, and remember, this is educational content only. So what does this expert advisor actually do? At its heart, Exhaustion Reversion is a mean reversion system. That means it is not trying to chase a trend. Instead, it waits for price to become stretched away from what it considers fair value, and then it looks for that stretch to snap back toward the middle. What makes this approach unusual is the signal it waits for before it acts. Most chart strategies rely on moving averages, oscillators, or classic patterns. This one adds something that almost no retail strategy uses. It estimates the effective bid-ask spread of the market using only the high and low ranges of two consecutive bars. This is the Corwin-Schultz estimator, published in 2012. The core idea is that a bar's high tends to be a buy and its low tends to be a sell, so the observed high-to-low range is slightly inflated by the spread. By comparing the individual bar ranges to the combined two-bar range, the strategy can back out an implied spread without ever needing tick data or volume data. That makes it robust even on symbols where reported volume is unreliable. When that estimated spread suddenly spikes, it suggests a thin book stress event or a liquidity gap, the kind of dislocation that often reverses once liquidity providers step back in. That is the moment the strategy is interested in. Direction comes from a separate tool. The strategy keeps an exponential moving average, or EMA, as a baseline of fair value. If the spread spikes while price is stretched well below that baseline, it looks to fade the move upward. If the spread spikes while price is stretched well above the baseline, it looks to fade the move downward. Everything is self-scaling through the average true range, so the strategy adapts to changing volatility. It is best suited to a patient, analytical trader studying liquid FX majors or metals such as Eurist or ZOST on time frames from 5 minutes up to 30 minutes. Let's walk through the exact logic, step by step. The expert advisor only acts once per newly closed bar, so it ignores the noise inside a candle and waits for confirmation. On each closed bar, it records the high, the low, and the close, and it computes the Corwin-Schultz estimated spread from the two most recent bars. Next, it builds a rolling picture of what a normal spread looks like. It takes the spread readings over a look-back window. The default is 50 bars, and it calculates the average and the standard deviation of that history. This is essentially a z-score. The strategy detects a spike when the current spread reading rises above the mean plus a chosen multiple of the standard deviation. By default, that multiple is 1.5. When the current reading clears that bar, the strategy treats it as a genuine illiquidity event rather than ordinary market chatter. A spike alone is not enough. The strategy also measures how far price has stretched from the EMA baseline, and it expresses that distance in units of average true range. By default, price must be stretched at least 1.5 times the ATR away from the baseline. For a long, two things must align on the closed bar. The estimated spread must spike, and the close must sit at least that stretch distance below the EMA. When both are true, the strategy signals a buy at the ask price. The protective stop is placed below the spike bar's low, offset by 1.2 times the ATR, and the take profit is set 2 times the ATR above entry by default. For a short, the mirror applies. The spread must spike, and the close must sit at least the stretch distance above the EMA. The strategy then signals a sell at the bid, with the stop above the spike bar's high and the target set in ATR multiples below entry. There is also a smart exit. If a trade is open and price reclaims the EMA baseline before hitting the stop or target, the strategy closes the position immediately because the reversion thesis has already played out. Finally, a live spread filter skips new entries when the current market spread is wider than the maximum allowed points, and only one position per magic number is held at a time. Let's read through the code as it appears in MetaEditor. At the top, we have the input parameters. EMA period, defaulting to 50, sets the fair value baseline. ATR period, defaulting to 14, drives both the stretch measurement and the stops. Stretch multiple at 1.5 is how many ATR units price must be pulled from the baseline. Spread lookback and spread spike multiple define the rolling window and the spike threshold for the estimated spread. SlAtrMult and TpAtrMult size the stop and the target. Max spread points blocks entries when the live spread is too wide, and lots and magic set the position size and the identifier. Just below that, the spike boolean is the z-score test. It is true only when the standard deviation is positive and the current spread reading exceeds the mean plus the spike multiple times the standard deviation. Now look at the long block. The condition is that stretch is less than or equal to negative gate, meaning price closed well below fair value. The entry is taken at the ask, the stop loss is placed below the recent low minus the ATR multiple, and the take profit is set the ATR multiple above entry. If both distances are valid, the code calls trade.buy. The short block mirrors it exactly. When stretch is greater than or equal to gate, price closed well above fair value. The entry is the bid, the stop sits above the recent high, the target is set below entry, and the code calls trade.sell. Let's bring this to life on the chart. On the price panel, you can see the blue EMA baseline, which represents fair value that price tends to gravitate back toward. In the subpanel below, the gold line is the Corwin-Schultz estimated spread, plotted as a z-score. The dashed red line is the spike threshold, sitting at the mean plus 1.5 standard deviations. Whenever the gold line climbs into the shaded illiquidity spike zone above that threshold, the strategy is on alert. Watch the opening candles. Price is resting close to the EMA baseline, and the estimated spread down below is calm and quiet, well under the threshold. Then a wave of selling arrives. The second and third candles print lower closes, pulling price steadily away from the baseline. As price slides, notice how the estimated spread starts to climb, because the bar ranges are widening. Now look at the fourth candle. It is a wide range bar with a long lower shadow, the classic footprint of a liquidity gap where resting orders are swept and price briefly overshoots. At that exact bar, the estimated spread surges up into the illiquidity spike zone, clearing the threshold. At the same time, price is closed well below the EMA baseline, more than the required stretch in ATR terms. Both conditions align, so the strategy signals along, and you can see the buy entry marker on that candle. The protective stop is tucked just below the spike bar's low, giving the trade room beyond the dislocation. From there, the reversion thesis plays out. The next candles recover, closing higher one after another as liquidity returns and price is pulled back toward fair value. By the time price climbs back to the EMA baseline, the take profit target has been reached and the trade is complete. Remember, the strategy would also close early right here if price simply reclaimed the baseline, because the move it was fading has done its work. Now the mirror image sets up. Price keeps pushing higher, candle after candle, stretching above the EMA baseline this time. On the 10th candle, another wide-range bar appears, this time with a long upper shadow, and the estimated spread spikes back into the illiquidity zone. Price has closed well above fair value, more than the stretch requirement, so the two conditions align on the short side. You can see the sell entry marker there, with the stop placed just above the spike bar's high. Then price rolls over. The following candles drift back down toward the EMA baseline, and when price returns to fair value, the take profit target is met and the short is closed. Notice the symmetry. In both cases, the strategy waited for an illiquidity spike combined with an overstretched price, faded the dislocation, and aimed for a controlled reversion back to the baseline. With a take profit set at 2 ATR and a stop near 1.2 ATR, the default reward to risk profile is roughly 1.5 to 1 on paper. Of course, real markets do not always revert, and losing trades are a normal part of any system like this. And that brings us to the end of our look at spread exhaustion reversion. Today we explored how this expert advisor estimates the effective spread using only high and low prices through the Corwin-Schultz method, how it treats a spread spike as a sign of a liquidity dislocation, and how it fades that move back toward an EMA baseline of fair value, with ATR-based stops, targets, and an early exit when price reclaims fair value. Remember, everything here is educational information only, and nothing in this video is financial advice or a recommendation. Trading carries real risk, and losses do happen. If you found this breakdown helpful, please like the video, subscribe for more MetaTrader 5 strategy analyses, and leave a comment with any strategy you would like me to cover next. You can learn more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.